My name is Rian Martins from Cape Town, South Africa, and I became a big fan and avid reader of your ideas about 10 years ago. In 1999, I did an MBA and was nicknamed Warren Buffett because I quoted you in all the classroom discussions. All I wanted to learn was how to value a stock and think about stock prices, but sadly I was rather disappointed to find out that our MBA did not really teach that. Mr. Buffett and Mr. Munger, my question is this. If you had to predict who would be the superior investors from a group of young, bright people who share your investment philosophy and possess the realism and discipline you referred to earlier, which characteristics or work habits would you like to know about the individuals in the group, and what weighting would you place on each factor to ensure the greatest probability of your prediction being correct?
Well, that's too easy a question for me, so I'll let Charlie answer that.
I think the fair answer to that one is that I'm not capable of answering it.
No, but I do. I think this. I think that's exactly right. I mean, if you ask me, how should you pick a wife? 18% to humor, 12% to looks, 17%, to parents. I can't give you the formula, but I think you'll make the right decision. When you get. And I think if Charlie and I were around a dozen very bright MBAs with good records and all of that, and we spent some time with them, I think we'd have a reasonable chance of picking somebody from that group that might not necessarily be number one, but they would be in the upper quartile in terms of how they actually turned out. But I can't tell you. I can't tell you how to. I can't write out a software program or anything that will enable you to do that. I had that problem exactly at Solomon on that Saturday morning, whatever it was, August 17th, and I had to pick a guy to run the place. And there were a dozen or so people that all thought that they were the ones, or a number of them thought they were the ones to run it. And they all had high IQs, and they all had lots of experience in investment banking and everything. And in the end, I had to pick one. And I did pick the right one, I will say that. And, could I be 100% sure at that time was the right one? Well, probably not, but I felt pretty sure I had the right one. And I can't tell you. I've had people say to me, well, what did you ask them and how did you evaluate it? Because I only had about 3 hours to do it. And I don't know. I mean, I can't write you out a set of questions that you should ask somebody. Some of it may be body language and different things of that sort. There are a lot of variables in it, but I think in the end you would have picked the same person I picked if you'd been in that spot. You'd had to pick somebody in the 3 hours, but quantifying it for you, I can't do it. Charlie, have you got numerous?
Yeah, well, when multiple factors are causing success, you get these anomalies. You could have two people who are going to be equally successful, and one is terribly good at A and terrible at Z, and the other is terribly good at Z and is very good at Z and terrible at A. They're equal. Which factor is most important? The answer, it doesn't matter in that case. When you got multiple factors, great strength in one will compensate some for weakness in another, and the factors can be quite different. I think the investment world is full of people who are succeeding based on quite different sorts of talent.
I'm very leery of economic correlations. I mean, I spent years fooling around with that sort of thing, and I mean, I correlated stock prices with everything in the world, and the problem was when I found a correlation. I mean, it's you've seen these things on whether the AFC or the NFL wins the Super Bowl and all of that sort of thing. You can find something that correlates with something else, but in the end, a business or any economic asset is going to be worth what it produces in the way of cash over its lifetime. And if you own an oil field, if you own a farm, if you own an apartment house, with the oil field, it's the life of the oil field. and what you can get out of it. Maybe you get secondary recovery, maybe you get tertiary recovery. Well, whatever it may be, it's worth the discounted value of the oil that's going to come out. And then you have to make an estimate as to volume and as to price. With a farm, you make an estimate as to crop yield and costs and crop prices. And the apartment house, you make an estimate as to rentals and operating expenses and how long it'll last and when people will build other new apartment houses that potential renters in the future will find preferable and so on. But all investment is laying out some money now to get more money back in the future. Now there's two ways of looking at getting the money back. One is from what the asset itself will produce. That's investment. One is from what somebody else will pay you for it later on, irrespective of what the asset produces, and I call that speculation. So if you are looking to the asset itself, you don't care about the quote because the asset is going to produce the money for you. And that's what society as a whole is going to get from investing in that asset. Then there's the other way of looking at it is what somebody will pay you tomorrow for it, even if it's valueless. And that's speculation. And of course, society gets nothing out of that eventually, but one group profits at the expense of another. And of course, you had that operate in a huge way in the bubble of a few years ago. You had all kinds of things that were going to produce nothing, but where you had great amounts of wealth transfer in the short term. As investments, they were a disaster. As means of wealth transfer, they were terrific for certain people, and they were for the other people that were on the other side of the wealth transfer. They were disasters. We looked solely. We don't care whether something's quoted because we don't buy it with the idea of selling it to somebody. We look at what the business itself will produce. We bought See's Candy in 1972. The success of that has been because of the cash it's produced subsequently. It's not based on the fact I call up somebody at a brokerage house every day and say, what's my See's Candy stock worth? And that is our approach to anything. On interest rates, I'm no good. I bought some REITs a couple of years ago because I thought they were undervalued. Why did I think they were undervalued? Because I thought they could produce 11 or 12% in terms of the assets that those companies had, and I thought an 11 or 12% return was attractive. Now the REITs are selling at higher prices, and they're not as attractive as they were then. But you just look at every asset class, every business, every farm, every REIT, whatever it may be, and say, what is this thing likely to produce over time? And that's what it's worth. It may sell at vastly different prices from time to time, but that just means one person is profiting against another, and that's not our game. Charlie?
Yeah, what makes common stock prices so hard to predict is that a general liquid market for common stocks creates from time to time, either in sectors of the market or in the whole market, a Ponzi scheme. In other words, you have an automatic process where people get sucked in and other people come in because it worked last month or last year, and it can build to perfectly ridiculous levels, and the levels can last for considerable periods. Trying to predict that kind of thing, sort of a Ponzi scheme, which is, if you will, accidentally thrown into the valuation of common stocks by just the forces of life. By definition, that's going to be very, very hard to predict. That's what makes it so dangerous to short stocks, even when they're grossly overvalued. It's hard to know just how overvalued they can become in addition to the overvaluation that exists. And I don't think you're going to predict the Ponzi scheme effect in markets by looking at the price of gold or any other correlation.
Charlie and you're pulling a figure out of the air. We have probably agreed on at least 100 companies, maybe more, that we felt were frauds, bubble type things. And if we'd acted on shorting those over the years, we might be broke now. But we were right on probably just about 100 out of 100. It's very hard to predict how far what Charlie calls the Ponzi scheme will go. It's not exactly a scheme in the sense that it isn't concocted in most cases by one. It's sort of a natural phenomenon that seems to nursed along by promoters and investment bankers and venture capitalists and so on. But they don't all sit in a room and work it out. It plays on human nature in certain ways, and it creates its own momentum, and eventually it pops. And nobody knows when it's going to pop, and that's why you can't short. At least we don't find it makes good sense to short those things. But it is recognizable. You know when you're dealing with those kind of crazy things, but you don't know how high they'll go or when it'll end or anything else. And people who think they do, sometimes play in it. And other people know how to take advantage of it. I mean, there's no question about that. You do not have to have a 200 IQ to see a period like that and figure out how to have a big wealth transfer from somebody else to you. And that was done on a huge scale, in recent years. It's not the most admirable aspect of capitalism.
What's interesting about Japan is that I don't think anybody thought that a major modern Keynesian democracy pervaded by a good culture in terms of engineering, product quality, product innovation, and so forth, could have a period where you would have negative 13 years without major depression either. I think that it would occur while interest rates were going down, not up. I think that was so novel that the models of the past totally failed to predict it. But I think these anomalies are always very interesting. And I think it's crazy for Americans to assume that what's happening in Argentina and what has happened in Japan are totally inconceivable forever in America. They are not totally inconceivable.
You had a huge bubble in equity prices in Japan, and now you've had interest rates go to virtually nothing. You've had the passage of time. The country hasn't disappeared. People are going to work every day, and you've had the Nikkei, now at a third of what it sold for not that many years ago. It's an interesting phenomenon.
And huge fiscal stimulus in the whole period from the government.
Post-bubble periods, I think, depending on how big the bubble is, and how many were participating in it, but post-bubble periods, I think, can produce fallout that not everyone will be terribly good at predicting.